And welcome. This is Ivan Oberon's Money Matters. I am Ivan Oberon. I am the co-founder of Coast to Coast RIA. And we got a very special webinar for you today. We have my new friend, Drew. Drew, I don't know if I ever got the pronunciation of the last name. Is it McCabe?
Yep, you got it, McCabe.
All right. We got my friend, Drew McCabe, whose name I did pronounce right on the very first try. And it is Thursday again, and we're in July 3rd already. We're almost about to celebrate our independence. And what better way to celebrate that than to have a webinar to teach you a legal way to keep more of your profits from Uncle Sam? How about that? We couldn't have planned this time, this webinar, any better. And like always, I want to encourage you guys to become allergic to average. Don't settle for what the media and what society and what even Uncle Sam tells you is okay. Just enough. Go after excellence. Go pursue your dreams and everything that is out there, because within your reach, as long as you follow the success principles that we always exhort and teach and promote, and obviously we do so because it reminds us and encourages us to do the very same thing, because success is a habit. And Drew McCabe knows all about that success habit because he's done all kinds of different things. He is a serial entrepreneur. He's kind of a man after my own heart. After talking to him for about 45 minutes this morning, found out how much more we have in common. But he really has a passion for everything real estate investing. He's been involved in thousands of real estate transactions, everything from your conventional fix and flips, which is what draws most people into the real estate investing world, which is how I got my start, buy and holds, which of course are rentals, to add to the wealth creation of the strategy, which is typically where the next step where people go. He's done new builds. He's done finance, which again is an area that I'm very interested in. And Drew, I'm going to pick your brain about that when we have more time, because Drew's also a hard money lender. So he lends money to people that do rehabs. So if that's you want to pay close attention to what Drew has to say and the information he's going to give you later on and how to get a hold of him. But he transitioned into the world of 1031 exchanges. And I'm going to let him explain to you in detail what those are. But it's a very creative way to either eliminate or really postpone taxes on profits on different things that you do. And as real estate investors, as people who are buying and selling properties and potentially even notes, and this is a question that I would have, but anything that you turn a profit on, of course, Uncle Sam is going to want to tax you on that. And the 1031 exchange is a legal way to help reduce, probably not eliminate, Drew can clear this up for me, but at least prolong and defer those taxes. So what I'm going to do is let Drew introduce himself, and then we'll go ahead and turn the screen over to him. And he's got a nice presentation that I will probably let him get through without interjecting too much. But we'll make this conversational and kind of informal for you guys, so you can have fun and prepare some questions. Feel free to ask them in the question bar as we go along. Raise your hand and I'll unmute you if you actually want to say your question audibly, or say them till the end. We will have a Q&A if you guys want to do that. So with that said, Drew, how are you, man?
I'm wonderful. Thank you, Ivan.
Yeah, well, thank you for being on here. I know it's taking some time out of your day and before the weekend, so I really appreciate it. Let me change the screen over to you and make sure that we can get you going. So you should see something on there that has you accept.
Got it.
And then pretty soon we should be able to see your screen.
Are you there?
And we're here.
Okay. First off, thank you, Ivan, again, for allowing me to come on here. And just, I love that allergic to average statement. And anybody who's listening now or is going to be listening to the podcast, you guys are already taking the medicine to prevent the allergic reaction to being average by taking the steps to listen to what Ivan has to say and what he's offering. So I commend you on that. So I appreciate the very kind introduction. Good, bad, or indifferent, I am a serial entrepreneur. It's in my blood. I just I love it. It pulses through my veins. I think it's one of the most fun and exciting and challenging um, occupations, I guess, for lack of a better
Well,
term,
and
out
you're
there.
probably certifiably unemployable, aren't you?
I am. I worked for a private equity firm for 8 months
Hmm.
in '08, and we were doing a startup that was actually using charitable remainder trusts. I won't go into detail; it's very high level stuff. But it was working for a private equity firm in a startup, and it was the worst 8 months of my life having to go. I'd drive downtown Denver. I had to park in a parking garage, walk to the office, and I was like, doggone, I really want to be wearing my shorts and flip flops today.
Right.
And
Oh my gosh, that's totally what I'm wearing right
so,
now.
me too. I think that's the entrepreneur's uniform. So to jump in here, this class that we're looking at on the webinar is actually a Colorado Real Estate Commission issued um, continuing education course. So it is a little bit geared towards realtors. So I apologize for that, and we'll kind of skip over some of that stuff. But we'll dive right in. First and foremost, as Ivan said so eloquently, the 1031 exchange is a legal way to defer your tax on the profit that you make from the sale of investment property. Um, a lot of people call them tax-free or tax-exempt, and unfortunately that's not the case. It is a tax deferral, but as Ivan alluded to, there is a way to eventually make that tax go away with proper estate planning and things of that nature. We won't dive into that, but
Hmm.
keep that in the back of your head that you can make that tax eventually go away with proper planning. And as Ivan and Pete teach, not only is it so important to be setting your goals, but right along with those goals has to be the proper planning, the proper education that corresponds directly to those goals. Because if I say, I want to do a 1031 as one of my goals, well, that doesn't mean a whole lot if I don't know how 1031s work. I haven't gone out and bought a property, obviously, and things like that. So
Right.
um, that's that. So we'll just kind of jump right in here. If you can see, we'll
Now,
circle
if we do
page
the
there.
1031 here, Drew, does that mean I get that jet on the upper left hand corner there? Because if that's the
Yes.
case, or I'll take the oil rig too. I mean, that could be good.
Well, see what we do there is that middle picture is probably, it can be anywhere you want. Maybe it's the Hamptons, maybe it's Newport Beach, whatever. So you take your jet to there, and then you fly down to Houston, check on your oil, and then fly back.
Got it.
And
Okay.
the reason you've been able to do that is because you haven't had to pay Uncle Sam upwards of 20+% in capital gains
Uh,
taxes on your properties that you sell. So
I'll let you know that there is an app for the iPhone so that you can book your private jets. So,
is that like NetJet or somebody like that?
yes, yes.
Yes. You and Mr. Buffett, I think he owns that one, doesn't
I don't know.
he? I think he does. Um, so this is going to talk about the course objectives. We'll kind of skim over this because this isn't fully applicable. But my dad, who is of utmost importance to me and my mentor, he likes to say down there in the bottom, it's not what you make, it's what you get to keep that counts.
Sure.
So that's kind of one thing that we kind of beat into our clients is, so what if you made $50,000, but if you had to pay a whole chunk of that in tax, you're not keeping 50 grand. So
Right.
it's not what you make, it's what you keep that counts. So,
Now,
so
is that app apply also? You said investment properties, but does it also apply to the profits that we would make off of a flip, for example?
that is a great question, Ivan, and the answer is typically no,
Hmm.
but it depends on how you structured the deal.
Okay.
The 1031 exchange is really well, I'll give you a real brief history on it. It started way back in the day where Ivan and I were both farmers, and maybe I grew soybeans and he grew corn. And I grew mine for a long time until the soil wasn't able to grow soybeans anymore, and his vice versa for corn. And so
Right.
what Ivan and I would actually do would be swap deeds or
We gotta
exchange
rotate the
deeds.
crop. Yeah.
Yep, and that's really the 1031's really been around since 1920s. That's kind of the basis of where it started. Is we would just go out and swap deeds or exchange, and then it morphed. And then there was kind of a landmark case. It was out of Oregon, and it's called Starker. So some people may have heard the term a Starker exchange.
Hmm.
Starker was a landmark case that really gave us the 1031 exchange form that we have today. And I won't bore you with all the details, but it's really what birthed the type of exchange that we use today. So.
Okay. So what we're
So
really, as we get forward, moving forward here, I know people want some of the meat and content, but I always like to get a little bit personal as far as strategy. Like what makes you different, and I think what makes the people that we work with different, why they're so good, is because there's always a good story behind it, why you got into it, what the experience is, and what you see as the real benefit in this strategy. So some of us might not be in a position where we can use a strategy right now, but getting that relationship going and making that connection to who you are as a person, as an individual, why you're in this business. That way, when we do get down the road and we have either an investment property or some other type of property, because the way I understand it, and you can go into this later on, is you can actually do a 1031 exchange on different types of properties. It doesn't have to be, say, a single family home or even an apartment building. It could be other types of property that you can do an exchange on. If I got that right.
You are correct. So the biggest majority of 1031 exchanges that happen is real estate.
Mm-hmm.
So selling that single family home and going out and buying a duplex. And a lot of people will hear the term because it's actually stated in the statute is like kind.
Mm-hmm.
And people think, well, that means if I sell a condo with a purple door, does that mean I have to go buy another condo with a purple door? And that's not the case. In the real estate realm, it's any piece of real estate for any other piece of real estate. So
Okay.
right now, I mean, this last week we did, I think we closed 8 deals. Everything from dirt to a duplex to a 6-unit and oil and gas rights.
Okay.
And they're going to roll into whatever. We don't even know yet. But the real estate box is really broad. And then the reason like we have the jet is you can actually do a 1031 exchange on a jet. That's considered personal property. Or equipment, farm equipment. I was up in a meeting in a rural town here in Colorado yesterday where our client is selling a $2.7 million ranch in Wyoming and buying a roughly $2.7, $3 million ranch in Colorado. Well, the one they're selling in Wyoming, they've got about $300,000 worth of equipment, which for those of you that aren't familiar, these are combines and tractors and that type of stuff.
Sure.
So when they sell that, they're actually, even though you wouldn't think that a tractor would increase in value, it's actually not increasing in value. What it's done is they've depreciated it down. So maybe they bought it for $100,000, but the depreciable life on that piece of equipment is only 5 years.
Mm-hmm.
And so now they've got a zero basis. And so if they sell it for $50,000, they're actually going to pay tax on that $50,000 depreciation recapture. So
got it.
You can see this 1031 is much bigger than people realize, and it's really about education and understanding. So
right now, and that's why I wanted to kind of get into how you got into it. Didn't you create a different company with your dad? So I mean, it's kind of was in your family, wasn't it?
It was a family business. So my dad started in this business in 1996. He was a real estate attorney by trade. I came on and started working with him and his partner in roughly 2000. In 2002, him and his partner had just different visions for the business. So he and his partner split up, and he and I and basically half the staff went and started one. And that was right when things were crazy. And we were based here in Denver, and then we had 8 offices around the U.S. We had Hawaii, Arizona, Florida, Georgia, all over the place. And we really rode that wave hard, and we ended up selling the business in 06, 07. So we sold just right at the right time and stepped out of the business. And that's when I started doing more flips and rentals and hard money lending. And then I'm a big, study guy. And so look at what's happening around you. You kind of get the sense. And so here in Denver, especially the market about a year ago started going bananas.
Mm-hmm.
And when I say bananas, for example, healthy number of houses in the Denver kind of metro area is somewhere between 25 and 30,000 houses on the market. I think in last numbers I remember seeing in roughly May, we had 5,700.
Wow.
So it's just the prices have gone through the roof. So anyways, all that to say, I started looking at it and saying, okay, there's going to be a need again. A lot of 1031 companies went away because in '08 when the market crashed, there was no more business. So
Right.
being an entrepreneur and seeing the need, I said, let's start up another 1031 exchange company, and that's where we came up with Exchange Resource Group.
Okay. Got it.
So so jumping here forward, like I said, we'll skim through this stuff. Ivan, please keep interrupting me. I certainly enjoy your questions, and anybody else has me, let me know.
Yeah, well, I'm just like concerned now because I think I'm gonna have to take a quiz, and I don't know what's gonna happen. I'm not sure if I'm gonna
Well,
have the right answer or not.
well, it's just like school. If you don't know, you can speak next to the guy next to you. We're not grading on this one. So did you wake up this morning hoping and praying for a 1031 exchange to do? Well, probably not. Um, like we said, 1031 exchanges, it's one of those things where you hear about them. Yeah, I kind of know about them, but you may not, like you said, you may not be doing a deal or whatever. So it's funny, in our business, a majority of our phone calls basically start with, I've heard of a 1031 exchange, explain it to me.
Hmm.
And that's really how it goes. So it's really an education thing for us and how we market. So 1031s are boring? False. They're not boring. They're fun. They're a quick sale, a quick buy, because the IRS says, hey, we're going to let you defer tax, but you've got to do it in a short period of time, and we'll go over that.
Hmm.
And then this is a question more geared for realtors, but 1031s are a way for you to earn, not steal, business from your competitors at the closing table. And why is that? Is because if you get yourself educated, learn about these things, you're going to be seen as the expert,
Right.
thus earning the business of your clients.
Yeah, and there's a lot of times, and who knows, we may have a real true or two on the line, but sometimes, if you can actually save that money, and you're dealing with somebody who's selling a property, which a lot of times they do. I have one of my investors was actually selling his property, and he had to do a 1031 exchange, and he bought basically upgraded and bought a different rental property with that money.
Mm-hmm.
So,
Yeah, we've
absolutely.
actually, true story. It wasn't me, it was my dad. Was at a closing, and we try to attend as many closings as we can. Obviously, where we're located, but
Hmm.
um, we go to the closing. We're representing the buyer, so they're on the second half of their exchange. They're buying their replacement property. Sitting down, going through all this stuff, and the person across the table is obviously the seller. And they said, "Well, who are you?" And Dan says, "Well, I'm the 1031 exchange company." And they said, 1031 exchange, what is that? And he said, well, it's a way to defer taxes on investment property, things like that.
Hmm.
And the seller turns to their realtor and says, why didn't you tell me this? And the realtor, you want to talk about feeling dumb in a room full of people. He kind of got this sheepish look on his face, and I'm sure he wanted to crawl out the door. Ended up, they had held this property for investment purposes. It was a rental for them. They had never heard of the 1031. The realtor didn't tell them.
Hmm.
So we actually took a timeout and said, "Hey, just stop the closing for 1 minute. We haven't closed yet." Dan, my dad, called up the office and said, "Hey, we got this person wants to do a exchange." We whipped out the documents, got them over, and ended up getting an exchange from that seller. Um, but it was really because they were uneducated, the
Sure.
realtor was uneducated. So
And there was the opportunity. It's all about
the
what
opportunity
you
was right
know and who
there.
you know.
Exactly. Uh, let's see here. Okay, the pass the cash. This is once again for a realtor because you have to have a sell and a buy, and so from a realtor standpoint, you're gonna get two commissions in a short period of time because the people are required to go buy another property.
Sure, but it's not necessarily just for a realtor. It's for us as consumers as well because we're involved in that transaction. So if I have a property or some kind of property that I need to sell and that I want to defer the gains on, then that applies to me too. So I need to understand how that works.
Exactly, and that's what we're going to jump in here. So, a couple key questions: of what was the property used for, and what's the money from the sale going to be used for? Um, so there's six basic requirements when you do a 1031 exchange. And so now we're kind of shifting from talking to the realtor to talking to the investor.
Hmm.
So the IRS has created six basic requirements. The first one is pretty simple: is that the property is held for investment. Now this goes back to your question about the fix and flips. This word investment is a pretty broad term because you and I, Ivan, both know that a flip is an investment for us.
Sure.
Most of the people on the phone realize the flip is investment. The problem in a 1031 exchange scenario is the 1031 exchange is to defer long-term capital gains. And within the code, it says the people that are excluded from doing exchanges are people that hold property for inventory, which is going to be like, you know, Toll Brothers, you know, U.S. Home, the big home builders. They can't do 1031 exchanges because they hold their properties for inventory. Okay. So anybody holds them for inventory, and then dealers and developers. And the IRS kind of sees fix and flippers as dealers. So what the IRS doesn't want people doing is to be able to defer what would ordinarily be short-term income.
Okay.
And when you do a flip, that's going to be short-term income tax at your normal tax rate. Yeah, 35%, whatever it is. So the term held for investment, we strongly suggest that you hold a property for a minimum of a year and a day.
Okay, and that's so you qualify for that IRS rule.
Yeah, exactly. Yep. So if you're doing a flip, you could hold it for long term, and then that way it gives you two options. Either one would be maybe now I can do it as a 1031, or two, a little bit of advantage of holding it long term is now you're subject to long term capital gains versus ordinary income.
Mm-hmm.
A lot of people get hung up on that held for investment. That's one of the big things that we talk about when counseling with people.
Okay. Yeah, so I couldn't do that if it was an investment property, but I decided to quote unquote flip it in 6 months, even though we held it for the investment for that 6 month period of time, it still wouldn't qualify.
Well, potentially it could. So if you held it for 6 months and then fixed it up 6 months and you've held it for more than a year, then that could potentially qualify. It's really what is your intent? That's what the IRS talks about. Well, what is your intent, Ivan? Is your intent to flip this thing, or was it to hold it for long term?
Okay.
And it's kind of the straight face rule. You got to be able to stand in front of somebody straight face and say, well, I would truly hold this thing for, therefore it's not going to qualify as a
okay. Got it.
So the next rule is one of the two timeframes which the IRS puts on a 1031 exchange. From the day you sell the property, you have 45 days to identify up to 3 properties that you'd like to purchase.
Okay.
Okay.
So I kind of got to get on the ball.
You got to really get on the ball, and that's kind of where it goes back to those realtors. Is as a realtor, you got to really be, working hard for your client and earning your money. So, we highly recommend don't start looking the day after you close your property. Be out looking, a month before that. And you can put something under contract for your replacement property before you sold your old one. But the key is you have to sell the old one before you buy the new one in a straightforward exchange.
Okay. Yeah, we had a situation with a couple of guys from Northern California. They came to our assisted living facility training that we do in Phoenix, and that's kind of what they had. They had some money, almost $500,000 burning a hole in their pocket because they had sold a property. They do high-end rehabs and stuff like that, and so I'm not sure how they got theirs to qualify as a held investment, but point of the matter is that they were like at day 41 when when they came to our class, and so fortunately we had a couple of operating facilities for them to look at that were for sale, and they did end up putting an offer in on it and purchased it. So that worked out well.
Very cool, with 4 days to spare.
yeah, but then they have time. Then they have time though, right?
Yes. So then that takes us to the next rule, the 180-day rule. So after you identify that property or properties within 45 days, you then have a remaining 135 days for a total of 180. So they run concurrent to each other.
Okay.
So a total of 180 to then close on the properties that you identify.
Got it.
Pretty simple. The next rule is the qualified intermediary requirements, and that's what we are. That's what Exchange Resource Group, the IRS calls us a qualified intermediary. Another term is an exchange accommodator. And what we are is an unaffiliated third party.
Right.
Okay, so
Man,
the IRS
that's a
makes it very.
fancy term for middleman.
That's right. That's a great. Yeah, I don't like that term middleman, but that's really in essence what we are. The IRS basically says anybody that you have an agency relationship with cannot act as the qualified intermediary. So your real estate broker, your CPA, your attorney, your brother-in-law, your mom, your auntie, anything like that, they cannot be your qualified intermediary. It has to be an independent third party. What we do in our function is to prepare the paperwork on the sale of the old property, the purchase of the new property, track the time frames for you. The most important part that we do, and the kind of the hardest part for people to fully understand is they're not allowed to touch the money from the sale of their old property. We actually have to hold that money as the qualified intermediary on their behalf.
So does
So
from escrow
why the IRS
does it
is
go
doing this?
to a specific account then that you hold?
Correct.
Okay.
Yep. Now, in our case, not all qualified intermediaries are created equally. In our case, we set up what are called qualified escrow accounts, which are segregated accounts. So each one of our clients has their own account at our bank, of which the client is actually a signatory on the account. It's a dual signature account. One is ours and one is the client's. The reason we do that is for 100% security of the funds for the client. Because unfortunately, as we know, there are bad actors in every business, and unfortunately, prior to the downturn, there were some bad actors that had taken people's money, or had lost it in bad investments, or things like that. That was the main thing, was bad investments when the market turned. I don't know how many people on the phone have been around for a long time, but there used to be a very large title company. That also had a qualified intermediary, and they were investing in a certain type of investment that when the stock market crashed in 08, that investment dried up, and their 1031 company took down their entire 1031 or their entire title operation. And it was a very large title company. So security of the funds is of the utmost importance. So no matter if you don't use us, we would love it, but if you had an exchange going, you really want to find out, how are my funds held? How are my funds secured? That's a vital question.
Okay.
So moving right along, we're going to burn through this. Title requirements. So however you hold title to the old piece of property is the same way you need to take title to the new one. So Ivan's selling his rental property. If it's Ivan and Pete, let's say Ivan and Pete went in on a deal, then Ivan and Pete have to buy the new property.
Okay.
Where that gets a little sticky is, I know there's, and I'm sure.
Well, what if I don't like Pete anymore?
Great question. So if you and I don't like each other anymore, hopefully we were smart at the beginning and we bought the property as what's called tenants in common. And so basically that means I own 50% and you own 50%. And if I died, my 50% wouldn't go to you, it would go to my wife, and vice versa with you. So Ivan and Drew on this property. And we decided, you know what, Ivan, it's been fun, but I am ready to go to Hawaii and surf on the North Shore. And Ivan says, you know what, Drew, I don't really like surfing. I want to go to Aspen and ski. Let's go our separate ways. I could actually take 50% of the proceeds, go do an exchange on my 50%, and Ivan, you could go to Aspen and do an exchange on your 50% and go buy your ski condo.
Okay.
So that's the really easy way. Obviously, it can get a lot more convoluted and detailed, but we're not going to bore people with all that stuff. But title requirements, whoever the taxpayer is on the old property needs to be the taxpayer on the new one.
All right. So if I'm holding it let's just say I'm holding it in a trust, land trust, and my land trust is, 123 Property Street. Well, the new property that I'm buying is not going to be 123 Property Street anymore. So, what?
Correct.
How would I mitigate that?
So does the land trust have its own tax ID number, or does it flow through to Ivan's tax ID number?
Through an LLC.
Okay. So one way there's a couple different ways you could do it. The cleanest way to do it would actually be have 123 property address by the new property, even though they're buying 456 South Street, which can get kind of confusing, and that's why I never name my LLCs or my trusts after the property address because I've been in this business and I know a lot of people do, and because it makes sense. Oh, I'm buying 123 Main Street, so let's call it 123 Main Street Land
Trust.
Trust.
Yeah.
But you would just have 123 property address by 456 South Street, and then after the exchange is closed and finished, then you could sit down with your CPA and say, okay, how do we adjust this? Or you can do a name change or whatever.
Okay.
But
a couple extra steps.
Exactly. The last rule is the reinvestment rule. And what that says, what the IRS requires is that in order to defer 100% of the gain, you have to buy a property or properties equal or greater in value to the property that you sell. So back to Ivan and Drew's 123 property address property. We're selling it for $200,000, and we've got $100,000 worth of debt. So we're going to have $100,000 paid off to ABC Bank, whoever.
Okay.
And then we're going to have $100,000 sitting in our exchange account. And for this example, Ivan and Drew still like each other, so we're going to stick together and go buy something else. So we have to go out and buy not a $100,000 property because that's how much cash we have. We have to go out and buy a $200,000 property because that's what we sold for. And we have to use all that cash that came out of our old property into the purchase of the new one.
Okay.
Or properties. You can.
So it works out to be, like a 50% down payment on that case.
In that particular case, correct. Or we could say, hey, let's expand our holdings. We want to do a diversification, what we call a diversification exchange. But we want to sell one, and we want to go out and buy two. So we're going to sell one for $200,000. We're going to go buy two $100,000 properties, and we're going to put $50,000 down on each one.
Okay.
But the combined value of those two new properties we bought is $200,000, and therefore we defer all of our gain.
Okay, so they just want us to equal or lesser or greater value.
Equal or greater value, right? And a lot of people, that's a tough one because a lot of people think, well, wait a minute, Ivan and Drew, you paid $150,000 for that property, and now it's worth $200,000, so you only made $50,000. Shouldn't that be all you have to reinvest? And unfortunately, the answer is no. The IRS says play by our rules, and our rules say go buy something equal or greater.
And we can't buy something for lesser value because then do they not want us to have money left over and then have to pay the taxes on that, or what's the whole deal there?
Great question, Ivan. So you can buy something. Let's say we found just a smoking deal in Huntington Beach for 185. I know that doesn't exist, but just for giggles. So we sold for 200, and we find something for 185,000. So we're $15,000 short. And we say, you know what? There's just nothing else out there to buy. We can still do the exchange, but we're going to pay tax on that $15,000 that we bought down by. So then we're going to be hit with capital gains tax and recapture on that 15.
Okay, so anything that came to us anyway.
That's correct.
Got it.
So I'm going to skim through this real quick because we kind of delved into it pretty hard on this stuff. But held for investment, any property held for income or used to produce income can be exchanged for investment or income producing property. Rental property is always investment. Bare land is always investment. This is a simple example. Dick and Jane bought a duplex. They want to rent it out. Buy a condo on the beach. Does this qualify? Yes. 45-day rule. You identify 3 properties within the 45-day rules. If you identify more than 3 properties, it puts you into different categories of rules, and I'm not going to bore you with details, but it gets a little more complicated. And you'll see down there in the bottom, there's absolutely no extensions. 45 days is 45 days. So it doesn't matter if your 45th day falls on Christmas, Easter, New Year's, whatever. That's your day.
And you're basically starting from the day that the new deed is recorded, or whatever your closing date is, right?
Yeah. So what's interesting is, as you're well aware of, buying all over the country, different states close in different manners. So in California, you close an escrow, and then correct me if I'm wrong, but they record the deed and then they disperse.
Right.
Is that basically it? In Colorado, we have what's called a table closing state. So you and I would sit down, we'd sign all the documents. Today would be the day on the closing statement, but the deed actually probably wouldn't get recorded until maybe next Monday or something.
Mm-hmm.
Now with electronic recording, that's shortened, but for all intents and purposes, it's really whatever's on your closing statement as the closing day that's going to be the date to count.
Okay.
Calculated for 45 days.
And what about because you have attorney states and you have title states.
Correct. Yep. So East Coast tends to be attorney states. Same thing though. It's really whatever's on that settlement statement. That closing date on the settlement statement is going to be the trigger date.
Got it.
Hopefully everybody's hanging on with us. Have we had anybody have any questions?
Well, Drew, I'm doing my best to keep them awake. All right, come on, come on, pick it up a little bit, man.
I am boring. I said that at the beginning, I think.
So no extension.
As long as you keep interrupting me and adding a little liveliness.
All right, so I can't write it like a sob story letter and hey, I just need 2 more days. They won't do it.
They won't do it. The only sob letters that they've actually ever given an extension on is natural disaster areas.
Okay.
Like Katrina or Sandy or things like that. And we don't want that.
Well, I technically had found it, but now it's underwater. So
that's right.
Okay.
Exactly. So it was beachfront, and now it's a dock.
Yeah.
So
got it.
This is just some basic examples. I mean, we've really hit we really delve into the stuff before. We talked about the 180-day rule, the qualified intermediary rule. Like I said, it's required by the IRS. We say you must provide an escrow account. Not all QIs do. That's just how we work. Title requirements. This is actual code out of the 1031 exchange agreement, which pursuant to an agreement.
Mm-hmm.
I'm sorry, an exchange which pursuant to an agreement, the taxpayer transfers the property held for productive use, and then buys a new property. I don't need to read that. Hopefully everybody knows.
Now, is there a limit as to how many times I can roll funds over?
No.
No. Okay.
If you own 20 properties and you decided I'm going to sell all 20 of them today, you could do 20 exchanges. Or if you own one property, you could roll that property every 2 years or every year or every 3 years. Mm-hmm. And that's kind of what I talked about, alluded to in the beginning about that proper planning is you can defer the tax forever. And so kind of a funny saying in our business is you defer, and then die. And the reason being is because with that proper tax planning, if you wanted to, and you wanted to leave the property to your kids, if you pass away, so you bought this property in 2000, you defer it until 2100, you live a long, healthy life, you pass away, go on to see your maker, and you leave the property to your kids get to get that property at what's called a stepped up basis. So you paid $100,000 for that property in 2000, and in 2100 it's now worth $100 million. Mm-hmm. And you deferred all along the way. You exchanged up and up and up and up. Your kids get $100 million property with no tax deal with it.
Okay, so once you die, then whoever your beneficiaries are don't get stuck with that deferred tax.
That's correct.
Awesome.
Yeah. With the caveat of assuming Congress doesn't change rules. So. No man's person and property is safe while Congress is in session, I think is the saying goes.
Right. Now for that 45 days that you guys, or the maximum 45 days that you guys hold that in escrow, is that's a non-interest bearing account, I presume?
Yeah, because it has to be 100% liquid and 100% safe. It just goes and sits there.
Okay.
It's not an investment vehicle. You don't want us to be an investment vehicle. You want your money there when we're ready to go. When you're ready to go buy the property. Mm-hmm. And that's what happened to QIs in the past. Is they used it as an investment vehicle versus holding it in trust, basically in trust.
Okay, so that's like the one-way ticket to prison.
Yeah, exactly.
Okay, got it.
You got it. Title requirements. They hold title to the property the same way they take title to the new one. Sue's on the old property. She wants to add Fred right before the sale. Can she? Well, she can, but she could jeopardize the exchange. You wouldn't want to do it because the reason being is Sue has held this property for a long time as an investment.
Mm-hmm.
As soon as she adds Fred to the title, it's now changed the use of the property, and it could create bad tax consequences.
Well, why does it
You
change
wouldn't
the
want to do
use
it
of the property just by adding
because
another owner?
now, well, because Fred hasn't owned the property for investment purposes.
Okay.
He owned the property for one day, and the IRS, and these are devil advocate examples,
Sure.
playing worst case scenario. But Fred comes on, well, he doesn't own the property for investment purposes. He's owned the property for a day and then turns around and sells it the next day.
Well, let
Or
me
the
let me
divorce.
ask you this, and as it relates to that, because with my insurance background, the reason that there are so many different types of insurance, so many different types of policies, so many different types of exclusions and endorsements and all these different things is because at some point there was a need for that. There was an occasion, an event, a lawsuit, you know what I mean, that caused that to happen. And then all of a sudden, oh, well, this we need insurance for this kind of thing. So is that the same type of example there? I mean, I would imagine that somebody was going through the process. They didn't really know. They didn't educate themselves. Somebody got to add the title, and then all of a sudden it blew the thing up. Or is it just kind of a, we recommend you don't do this type of scenario? Or has something like that happened
It,
before?
yeah, I'm sure it's happened numerous times. And the difference between your example is you are dealing with private marketplace companies
Mm-hmm.
that see and adapt to change and market and things like that. We're dealing with the IRS.
Okay.
Guess what? They don't adapt to change very well.
Mm.
No offense if there's any IRS agents listening. They they make the rules and we have to play by them. Whereas the insurance world says, oh, we have a different market need. Let's change our product. Let's change our offerings. That type of thing.
Okay.
IRS says, hey, knuckleheads, here's the rules. Play by them or.
Pay the price.
Yep, exactly. So your equal or up rule, back to you and I example, Ivan, cash plus your debt is paid off is your reinvestment goal.
Okay.
Um, pretty simple there. So a review
So
of the
yeah, so I
basics.
really can't take anything and cross collateralize it. I can't take my 1031 and go buy a jet. I can't take my from a property. I can't take sell a jet and then go buy a new life insurance policy and put with that
That's
money
correct.
or any of that kind of
No,
stuff.
you cannot do that. You could sell a jet and go buy another jet.
Okay. So I
Um,
can go from my G5 to a G7. Is that what you're saying?
sure.
Okay.
Yeah,
Because I got to go up in value, right?
that's correct. Well, what's interesting on the personal property side is you can't sell your Cessna and go buy a G5. You're only allowed to go up or down certain amount of asset classes.
Oh, interesting.
So, yeah, personal property is its own little animal.
Okay.
Um, so moving right along here, this is just a review of what we've already talked about and who serves as a QI, what the functions are. There's some common problems. We're not going to go through this type of stuff. We've really kind of covered.
It's okay. All of
Everything.
our viewers are speed readers anyway, so no problem.
And I apologize. Like Ivan said, I'll provide you guys contact information. If for some reason you want to take a look at this PowerPoint, feel free to email me, and I can shoot this over to you. But in the essence of time here, we won't dive into all this points. So.
Man, we probably have that one realtor on the line that needed some CE too.
Yeah, well, unfortunately, unless he's in Colorado, which I will be able to help him out. So this is, once again, just designing, planning your 1031 exchanges, consolidation exchanges.
Mm-hmm.
You own 3 properties, one in Idaho, one in Indiana, one in Florida, and you're like, I'm tired of this long distance managing. I'm going to sell all 3 of them, and I'm going to go buy one in Manhattan Beach.
Yeah. And if you never sell a specific property and take the gains, then you technically won't ever end up paying taxes, right? If you just you exchange it a couple of times and you hold that last property until you die, then you've essentially deferred them permanently.
That's exactly what you've done, Ivan. Yep.
Okay. And is there any way to use this strategy for retirement building purposes or wealth building other than not paying the taxes?
Well, I mean, it is a truly, it's a tax deferral, but we really see it as a wealth um, explosion tool.
Hmm.
I mean, we don't have an example in here, but if you run the numbers, if you figure you have to pay 25% of every time you sell something, and if you run, Ivan and Drew next to each other, and Ivan's going to sell and do 1031s, and Drew's going to sell and pay the tax every time, it's just like the old,
Sure.
you know, doubling your money, putting a penny in and then 2 cents and then 4 cents, and it it explodes your holding capabilities.
Mm-hmm.
It explodes your portfolio. It explodes your wealth, which then in turn is a retirement plan. Um, there's actually ways while you're alive to make the tax go away with doing combining 1031 exchange and what's called Section 121. And Section 121 is your primary residence exemption,
Okay.
and you can marry the two of those together and wipe out large portions of the tax.
Hmm.
You don't wipe it all out, but you wipe out pretty good chunks of it. And
Okay.
so, just give you a real simple example: is you own a rental property for 5 years, you 1031 into a house that you could see yourself um, living in one day, and you buy that one as your replacement property. Then you rent that property out for another 3 or 4 years, and then you decide, you know what, I'm going to stop using that as a rental property, and I want to move into that as my primary residence.
Hmm.
You then convert the property to your primary residence, which is nothing magical. You just stop reporting it as investment property. You live in it, and let's say you live in it for another 3 years, and then you decide to sell it. You're now selling it as a primary residence, and you get to um, take some of that money tax free. Because Section 121, if you're not familiar with it, it says a single person can take up to $250,000 tax free on the sale of a primary residence, or a married couple $500,000. And so you combine the two of them together. That's a pretty sophisticated type of tax planning strategy. So I would highly recommend getting your CPA involved,
Sure.
but it can certainly be done.
Okay. Excellent. What's
So
next?
yeah, consolidation exchanges, diversification savings, retirement needs. Designing your 1031 for that, maximizing your investment yield. Maybe you've been sitting on a piece of dirt for a number of years, maybe inherited it. And like a good friend of mine says, um, dirt is great because God only made so much dirt, but it only eats and it never defecates. So therefore, it very, very rarely ever throws off cash flow unless you got a cattle lease on there growing hay or something. So maybe that property is appreciated and you roll that into a 6-unit apartment building that's going to throw off lots of cash for you.
Okay.
It's all about planning. It's all about following Pete and Ivan's goals and visions and things like that, and saying, okay, if I want to get to 100 units, how am I going to do it? I'm taking Ivan's 21-day challenge and I'm going to write these things down. And or I'm sorry, Pete's 21-day challenge. Pete and Ivan's 21-day challenge. And how are we
Yeah,
going to
man,
do
he
that?
might get kind of possessive if he hears you saying that.
Yeah, I know. I apologize.
Okay.
Pete, please forgive me.
Yeah, the idea was originally mine, but he's the one that made
it. He ran with it, right?
Yeah, well, he saw me writing my goals down in a book on a plane one day, and wondered what I was doing, and I told him, and like I told you this morning, Pete's the idea, like, spin-off guy, and so he took that, and then he decided that he could have an accessory, which meaning a nice book to do it in, and so he started doing it, and then all of a sudden he's like, man, well, we gotta let's do this, and boom, blew it up, and it's changing people's lives. It's amazing.
Well, what is it Haley's his daughter, his little daughter, right?
Yeah, it's one of them.
Haley, and I forget the other name.
Madison.
Madison, thank you. But what he calls themselves the visionary.
The visionary pit bull, yes.
Pit bull. So, anyways, back to the task at hand here is, if you're writing down those goals of 100 units, well, how am I going to get there without a game plan? And 1031 being part of that game plan, it's bringing a bigger bat to the game.
Sure.
you can go to a baseball game with a tiny little bat, but you walk in there with a big bat, and that 1031 is a big bat that's going to help you get around those bases a lot faster.
Okay. For all you sports fans.
Yes. So integrating the state plan, this was an actual client that we had that owned a farm in Kansas, I want to say. They sat down with their CPA and really had their stuff together and had an idea what they wanted to do. And what they did was, sorry, they sold their farmland in Nebraska and they went out and bought these 3 different properties, which happened to be like a little industrial building that was a bakery because their son was a baker in like New Jersey or something.
Okay.
And then they bought a kind of this Victorian Tudor looking thing here in a college town because their daughter was a college professor. And then 3 little townhomes or apartment buildings, wherever this was, in a different town for their 3rd child. And this was their estate plan: is they sold the land, they bought all 3 of these properties, and then mom and dad took the income, the rental income, off of all 3 of these combination of properties until they went on to see the good Lord, and then each one of the kids inherited their own separate property.
Got it.
And this is one of the most
smart.
beautiful examples of planning using a 1031 exchange with their estate. So
Yeah, and then they kept all that tax money as well.
they paid no tax. And what was kind of neat in this is mom and dad had worked really hard on the farm, and they, as people mostly know, farmers typically don't make a lot of money. They made so much money off of these rental income properties, and I forget exactly how it worked out, but I forget exactly, but the amount of money they made was, 10 times the amount they'd ever made on their best year farming or something like that.
Wow.
Plus the value of the real estate, that was there, and it was a really neat story of how you can use a tool.
Great.
This talks about the using the 121, the primary residence, and a 1031 exchange. This example gets a little complicated. We need to kind of make it a little simpler. But they've owned their home for many years and have $1 million gain. How do they exit this property without owing any tax? They could move out of the property, rent it for a year and a day, then sell the property and take $500,000 of the property as their primary residence, and then do a 1031 exchange on the balance, and move, and then rent out the new property as an investment, and then move into it later, sell it as a primary residence. It's just
some long-term planning.
It's very much long-term planning. Yep. This slide is talking about advanced exchange techniques. So what we've been talking about the whole time today is selling the old property, buying the new property. We, as in the 1031 world, kind of consider that a vanilla, sell and a buy. It's pretty simple. There's a way to buy the new property before you sold the old one. That's called a reverse exchange. And we won't dive into that, but basically it allows you to buy the new property before you sold the old one. So you find a smoking deal that you need to close quick. The reverse exchange is a mechanism that allows you to buy that property, then sell the old one, complete the exchange into it.
Okay.
It's quite a bit more advanced, more sophisticated.
Well, don't you need to have that extra cash laying around, or a separate loan or something like that?
Yeah, exactly. You hit the nail on the head. So in order to buy that new property, we as the QI actually buy it on your behalf. And so we set up a brand new entity, an SPE, and which is a special purpose entity that's used only for this transaction. It has no assets, it has no liability, so it's got to come up with the cash from somewhere to buy it, and that's where you as the client either have the cash under your mattress, or you're working with a bank who would be willing to loan to an LLC in which you don't have any ownership of. So the banks are kind of the key in that scenario. That example I told you, I was up yesterday on the ranch. We're actually doing a reverse exchange on the ranch, and the banker was there with us. Great banker. Totally got it, and is going to make the whole thing work because he understands it, which is a huge testament to building your team around you. Um, Getting Ivan and the Pete's of the world to help you with goals and all that kind of stuff. Finding a good banker, finding a good qualified intermediary, attorney, realtor, hard money lender, title company. Everything that Ivan and Pete teach, it really showed itself yesterday because the client had done that.
That's awesome.
Construction exchanges. You see a piece of property, you want to build a car wash on it. It's possible to do in a 1031 exchange because you're going to sell your apartment building and you want to build a car wash that doesn't exist yet. There's a way for us to construct a brand new property and then you 1031 into it. Once again, advanced, high level type of stuff, but very doable.
Yeah, because that doesn't sound like kind.
Right, it doesn't sound like kind, but it is because we buy it on your behalf, we build it up. Now, when we have it done, it's a completed building. And so you're selling your apartment building and a car wash. You're buying the real estate of the car wash. You don't buy the business of the car wash. You're buying the real estate, which everybody knows in most car washes, the value is in the real estate. You've got some equipment, things like that, but it is like kind. So
okay, got it.
Improvement exchanges are you want to buy an office building and convert it to a nightclub. We go in, we buy the property on your behalf, tear out all the cubicles and put in a bunch of speakers, that type of thing. Shifting the date of gain recognition. This is a tool, a very high-level tool that a lot of guys use. So if you're selling towards the end of the year, let's say you're going to sell in November and you've got a large gain, but 2014 has been a great year, and so you don't want to take that gain, but 2015 may not be as good of a year. So you do a 1031 exchange, and then the time frame is going to carry you over into 2015. And you basically go into it knowing that you're not going to complete the exchange, but you don't have access into those funds until 2015. And basically what you do is shift the date of the gain recognition from 2014 to 2015. Then you basically have an entire year to play with those monies because you're more or less, your tax isn't due until April of 2016. So now you have a year to play with that money until that tax is due.
Okay.
Once again, it's high-level stuff. Integrating with estate planning, combining 1031 to create permanent tax-free income, which is the 121. So that's it. There's a great quote at the end here. Judge Learned Hand. I know it's a funny name, but he was an actual judge. He's got a lot of great quotes if you ever look him up. I mean, he says, anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the Treasury. There is not even a patriotic duty to increase one's taxes. And we kind of use that as a great way to saying, hey, the 1031 is fully legitimate, it's fully legal. The IRS and the federal government are the ones that came up with the idea. And so why pay tax if you're not obligated to do so?
Sure. Yeah, well, that was great, and that's how they can get a hold of you, right? And for those of you listening on the podcast, if you want to get a hold of Drew, you can call him at 303-789-1031. Look at that, or you can check out their website at erg1031.com and reach them that way. What about an email for you, Drew?
Drew, D-R-E-W, at erg1031.com.
Awesome. Well, guys, I hope you enjoyed this presentation and that you learned something. At this point, why don't we open it up for some Q&A, see if you can throw some interesting questions out here, and either raise your hand and I'll unmute you, or you can go ahead and type it in the question bar, and we'll go ahead and answer it live, or ask it and answer it live for you. And then we'll go from there. And if not, I'll give you guys my links as well. Our website, of course, is c2crea.com. And if we're not friends on Facebook yet, I see some of you that we definitely are. I know I've seen you very frequently. You can look me up at facebook.com/Ivan Oberon for any of you listening to the podcast tomorrow or a year from now, and we're not connected yet. Well, you can find me there. You can email me at ivan@cdcrea.com, and any of my YouTube videos are on YouTube/Ivan Oberon. And why don't you, Michael, anybody have any kind of questions, comments, concerns, any commentary or critique of Drew's presentation? We'll put him on the spot.
Don't ask for critiques. That'll take forever.
All right, and if not, guys, all right, we just have a comment, and nice job. He's gonna have to watch it again. Maybe he came in a little bit late, missed the beginning part. Anybody else? Now, if you're getting into a place or you're not really sure what to do, but maybe you're getting into wanting to grow your portfolio of properties, or you have something else that maybe you need some advice on, can they contact you about that too, Drew? Do some pre-planning. Say this is going to be my goal for the next year and a half, 2 years. This is what I want to accomplish. Can you help me set myself in the right direction? Drew?
Yeah.
How about that? All right. Well, I'm just going to go ahead and answer the question for him because apparently he stopped paying attention, and that's okay. I was giving him a hard time. So reach out to him if you want to do some strategic planning, even if you're not at that place yet, but you think that this is a viable strategy for the future going forward. Definitely keep Drew's information. He's not going anywhere. This type of stuff is in his blood, and he'll be happy to help you. So thanks so much for spending a little over an hour of your Thursday with us, guys. Have a very happy 4th of July and 4th of July weekend. I know I'm going to be enjoying mine because we'll be celebrating our wedding anniversary as well. So don't expect to see me on Facebook very much this weekend. And until then, guys, just remember, it's Thirsty Thursday. If you're hungry for action, or if you're hungry for knowledge, you have got to be thirsty for action. So all the knowledge that you take in doesn't matter at all if you don't go out there and take the action required. So thank you so much again for tuning in, guys. And Drew, I'll talk to you soon.
Sounds good. Happy 4th.
You too.
Bye.